On June 2, 2026, Alphabet finalized the pricing of a $84.75 billion capital program. The capital program was implemented across three major channels: direct underwritten common equity offerings generating approximately $18 billion, a $40 billion at-the-market program scheduled to commence in the third quarter of 2026, a $10 billion private placement to Berkshire Hathaway, and a combined $19.25 billion public offering of mandatory convertible preferred securities. For the retail investor, the most accessible entry point into this capital raise is through the newly issued mandatory convertible preferred securities. These are traded on the Nasdaq under the symbols GOOGM, representing the Series A preferred stock, and GOOGN, representing the Series B preferred stock. These instruments are offering a fixed income yield of 6.25% during a 3-year holding period, followed by automatic conversion into common equity in May 2029. Mandatory convertible preferred stock is a hybrid instrument that sits between traditional bonds and common equity. Prior to its conversion date, the security behaves like a high-yield bond, distributing regular, cumulative dividends that take priority over any payouts to common shareholders. However, unlike traditional convertible bonds, which grant holders the option to either convert into stock or reclaim their principal cash at maturity, mandatory convertibles leave no choice. On the conversion date, the entire principal is automatically swapped for common stock.
To make these institutional-scale instruments tradable for the average retail investor, Alphabet structured the public offering using depositary shares. Each depositary share represents a 1/20th fractional interest in one share of preferred stock. This fraction reduces the liquidation preference, essentially the face value, from $1,000 per preferred share to a highly accessible $50 per depositary share. Dividends on these preferred shares accumulate on a cumulative basis and are scheduled for quarterly distribution on February 15th, May 15th, August 15th, and November 15th of each year, having commenced on August 15th, 2026. Because the initial dividend period beginning June 5th, 2026 was a partial quarter, the first payment on August 15th, 2026 was prorated to approximately $0.6076 per depositary share. Every subsequent full quarterly dividend is fixed at $0.78125 per depositary share. From a safety standpoint, Alphabet's financial strength makes the risk of a dividend suspension exceptionally remote. The corporation concluded the 2025 fiscal year with $402.84 billion in total revenue, an operating margin of 32.03%, and a net income of $132.17 billion. Most importantly, Alphabet's balance sheet reflects a net debt position of negative $75.80 billion, meaning its cash reserves and liquid investments dwarf its total liabilities. This immense liquidity backstop ensures that the preferred distributions are highly secure, offering a bond-like income stream.
The most complex element of GOOGM and GOOGN is the variable conversion mechanism at maturity, which dictates that the number of common shares received by the investor will adjust based on the average market price of Alphabet stock. This 20 trading day average, known as the volume-weighted average price, VWAP, is calculated immediately prior to the May 15, 2029 conversion date. This structural design creates three distinct investment outcomes, balancing downside protection against capped upside potential. As Alphabet's common stock falls below its initial offering price, $355.19.82 for Class A and $351.80.18 for Class C, the conversion rate locks at its maximum limit. For Series A, GOOGM, this maximum rate is 0.1408 common shares per depositary share. For Series B, GOOGN, the rate is 0.1421 common shares per depositary share. In this scenario, because the conversion rate cannot increase further to compensate for the drop in the stock price, the investor experiences capital depreciation on their $50 principal. However, this loss is significantly mitigated by the high 6.25% annual dividends collected over the preceding 3 years, meaning the preferred shareholder will substantially outperform a direct common shareholder during a market decline.
If Alphabet's common stock trades anywhere between the initial pricing level and the threshold appreciation price, approximately $444.05 for Class A and $439.75 for Class C, the conversion rate adjusts dynamically. The conversion rate is determined by dividing the $50 liquidation preference by the prevailing average market price of the common stock. Consequently, the investor is guaranteed to receive exactly $50 worth of Alphabet common stock at maturity. In this zone, the investor suffers zero capital loss and enjoys zero capital gain, realizing the entire return of the investment through the high recurring quarterly dividends. If Alphabet's common stock rallies above the threshold appreciation price, the conversion rate locks at its minimum limit.
For Series A, this minimum rate is 0.1126 Class A shares. For Series B, it is 0.1137 Class C shares. As Alphabet stock continues to rise, the value of the shares received on conversion will exceed $50, allowing the investor to share in the equity growth. However, because the conversion rate is capped at this minimum level, the investor's capital gains will lag behind those of a direct common stock owner. Essentially, the investor forfeits the first 25% of stock appreciation, the gap between the initial price and the threshold price, in exchange for the safety and income provided by the preferred dividend yield over the 3-year holding period.
One feature of this capital raise is Alphabet's proactive management of shareholder dilution. When mandatory preferred shares convert to common stock, the company must issue millions of new shares, which typically dilutes earnings per share (EPS) and places downward pressure on the stock price. To neutralize this effect, Alphabet purchased massive, privately negotiated capped call options from its underwriting financial institutions. Under these agreements, if Alphabet's share price rises, the option counterparties must deliver cash or shares back to Alphabet to offset the new share issuance. The cap prices for these transactions were established at $532.67 for Class A stock and $527.79 for Class C stock, representing a premium of approximately 50% over the public offering prices. For investors, this corporate hedging program is advantageous. While a standard equity raise of this scale might dilute earnings and drag down the common stock, the capped calls successfully insulate the capital structure, keeping effective dilution under 1%. This ensures that when preferred shares eventually convert into common equity in 2029, the fundamental value of those underlying common shares remains well protected.
Tax considerations. Dividends on the Series A and Series B preferred stock are paid on a cumulative basis. For individual U.S. taxable investors, these payments are typically treated as qualified dividend income, taxable at preferential long-term capital gains rates rather than ordinary income rates, provided the investor meets the minimum 90-day holding period requirement during the 181-day window surrounding the ex-dividend date. For corporate investors, these dividends are eligible for the Dividends Received Deduction, DRD, which significantly reduces the effective corporate tax rate on the yield. For retail investors residing outside the United States, purchasing U.S.-listed preferred securities requires careful attention to account structures, currency fluctuations, and withholding taxes to avoid eroding the high 6.25% yield. Dividends paid by U.S. companies to non-U.S. residents are subject to a standard withholding tax of 30%. For countries maintaining a double taxation treaty with the United States, this rate is typically reduced to 15%. Retail investors must ensure their brokerage platform has a valid W-8 BEN form on file to automatically secure this reduced rate at the time of distribution.
Investment risks and valuation headwinds. Despite the attractive 6.25% yield and strong credit rating of the issuer, investing in the depositary shares exposes capital to several distinct risk factors. The most significant risk is that the preferred shares do not offer the principal protection of corporate bonds. At maturity, the investment automatically converts into common equity. If Alphabet's common stock declines significantly over the next 3 years, the market value of the common shares delivered to investors will fall below the initial $50 purchase price, resulting in principal losses. The accumulated quarterly dividends provide a buffer but cannot prevent negative total returns in a severe market downturn. The macroeconomic environment in mid-2026 presents headwinds for yield-bearing assets. At its June 2026 meeting, the Federal Open Market Committee, FOMC, held the federal funds rate study at 3.50–3.75%. However, the central bank's updated economic projections showed a significant hawkish shift. Shorter-term U.S. Treasury yields rose, with the policy-sensitive 2-year Treasury yield climbing to 4.16% and the benchmark 10-year Treasury yield hovering near 4.38%.
If inflation remains sticky and causes the 10-year Treasury yield to rise towards 6% by the end of 2026, fixed income assets will experience valuation pressure. A rising interest rate environment increases the yield demanded by investors, which would depress the market price of Alphabet's 6.25% preferred shares if sold prior to maturity. The preferred shares are structurally capped in their ability to capture initial stock gains. Because of the variable conversion formula, preferred holders participate in 0% of Alphabet's capital appreciation between the initial price, $355.20/$351.80, and the threshold appreciation price, $444.05/$439.75. If Alphabet's AI initiatives drive a rapid increase in stock price, preferred investors will experience significant underperformance relative to direct common stock ownership. Additionally, option counterparties adjusting their hedge positions for the $16.75 billion capped call transactions may buy or sell common shares during key trading windows, particularly the final averaging period in May 2029. This hedging activity could depress common stock prices or increase volatility, affecting the final conversion rate and the value of the common shares delivered to investors.
Alphabet's mandatory convertible preferred stock represents a highly structured asymmetric derivative overlay on one of the market's strongest balance sheets. For defensive and income-focused portfolios, these preferred depositary shares are suitable for income-oriented investors seeking a yield premium over corporate bonds while maintaining exposure to the technology sector. The 6.25% dividend yield provides a reliable income stream that is 30 times larger than Alphabet's common stock dividend. The structure also provides a significant buffer against market downturns, outperforming common equity in declining, flat, or moderately positive stock scenarios. For aggressive growth portfolios, investors seeking maximum capital appreciation should avoid the preferred tranches. The dynamic conversion adjustment caps initial upside, making direct ownership of Class A Google L or Class C Google common stock the superior vehicle for capturing unconstrained gains from Alphabet's AI initiatives. For capital preservation portfolios, conservative investors seeking absolute capital preservation should avoid the preferred shares. Because the instrument mandatorily converts into common stock at maturity, it carries direct equity downside risk and does not offer the principal protection of traditional corporate debt or cash-redeemable preferreds. For investors, the Series A GOOGM preferred stock is slightly preferred over the Series B GOOGN preferred stock, as Class A common stock carries voting rights, providing a marginal advantage at conversion with nearly identical yield dynamics. Both series represent a highly effective balance between premium income generation and structured equity exposure.